Hello, welcome to another edition of Arrow Insights. I'm Ryan Synnot, and I'm joined by my co-host today, Matthew Ashton. Today we'll be diving into alternative investments. Let's start with a big question. Matt, what is an alternative investment?
Thanks, Ryan. That's a good question. Alternatives is something that people have trouble kind of defining. And really anything that sort of sits out those traditional equities and bonds that can bring something different to the portfolio.
Some common examples of alternative investments might include, private equity, private debt, commodities, even artwork. What do you think are the biggest benefits of adding these assets into a portfolio?
I think, Ryan, when we're actually looking at these asset classes, as you said, they've got to bring something different to the portfolio. So whether that be in terms of the stability of capital within the portfolio or the regularity of investment returns in terms of income, or uncorrelated. So
Thanks, Matt.
where markets are moving in going up, for example, that they may be moving sideways or in a different direction, and that can help with the volatility of our clients' portfolios.
So you're often expecting them to perform at different times to the traditional asset classes.
Yeah, that's right. And it's really important that we have that sort of smoother investment outcome for some clients. Just so that they're not hurt by the sequencing risk within our clients' portfolios. So sequencing risk really is that when you're taking money out of the portfolio, the pattern of returns can affect your outcomes.
Now let's sort of dive into some of the bigger or more prominent, investments within the alternative space. If we talk about private equity, it's a part of the market that's gathered a lot of traction over the past few years. It's becoming more and more accessible to everyday investors. What do you define private equity as?
I kind of like to see it more as sort of private markets. So the access to investments that aren't available in the public regime. And then it's either an equity or like a private debt opportunity that you can really get a different perspective on.
Beautiful. So often you'd find, within private market investing, companies or the valuation of businesses are often much more tied to their economic performance or the performance of that company itself. Within private debt, how do you view adding private debt to an investor's portfolio and the benefits that can bring?
Yeah, I think because it's not as mark to market as some other clients, as some other debt portfolio, it's less volatile. And you can also get, the manager can be a little bit more constructive in terms of how they operate. They can be a lot more hands-on in terms of the debt. So they can restructure it. They can put terms in the portfolio to protect the securities, protect the debt, protect the covenants of the investor. And that's something that you can't really do. You can't really be as constructive in the public markets. It's more rules based. So what by doing that, getting a little bit more hands-on, they can identify. They really know who they're lending to, if that makes sense.
One term that's often thrown around within private markets is an illiquidity premium.
Yep.
Do you want to talk us through what that means and how it's beneficial to maybe investors with longer term horizons who may not necessarily need to access 100% of their portfolio?
Yeah, so with private markets, Ryan, and accessing that e-liquidity premium, you're getting additional source of return because you're foregoing the ability to actually redeem your investments over a shorter term time horizon. And as a result of foregoing that liquidity, you get access to higher returns, which will be better outcomes for you and our clients over the long term.
I think particularly where investors have that longer term horizon and they may not necessarily need to access 100% of all their capital within the next month or the next quarter, accessing that illiquidity premium is a great benefit to introduce to portfolios.
Yeah, absolutely.
We move on to hedge funds. Just very quickly, what do you see, or what do you define as a hedge fund, and what do you think their roles are within portfolios?
So I think when some people talk about alternatives, hedge funds is the term that comes to mind, and hedge funds really are looking at the public markets that are available to you, but just approaching it in a different way. So maybe using leverage, maybe they're using derivatives. But the outcome really is to get a return out of these instruments that is uncorrelated to traditional equities and financial markets.
And how would that uncorrelated return benefit an investor's portfolio?
Yeah, so before we were talking about the markets going up and down, if you're performing at different times in the market cycle, you can get a smoother experience for your portfolio or for your client.
Thanks, Matt. And when it comes to accessing alternative investments, what do you see as the best way for clients to get access?
I think that it's really hard to get a broad depth of diversification for a client's portfolio if you go directly. So really through a managed solution is the best way to access these. Some institutional or through us in our portfolios, we have a diversified set of alternative investment managers that we use within our own portfolio to deliver good outcomes for our clients.
Thanks, Matt. That was really good insights into alternative investments. If anyone has any questions, please feel free to get in touch with their advisor. And thanks for tuning in to another episode.